Then we look at other operating expenses. Now, cost of goods sold which also includes depreciation, by the way. Are the variable costs of production. These are the costs that will change when you sell more stuff or less. But you also have operating expenses. You know, the rent that you pay for the headquarters. In general, this is selling, general, and administrative costs. And you also have things like research and development. You probably think there's not going to be too much R&D expense. Each company kind of does it differently. In this case, there's a big item called other operating expenses. I don't know what that is. If we go back to actual statements from SEC, you can see detail. But once you deduct operating expenses, from gross profit, you get operating profit or operating income. This is the amount of money firm earns before they have to worry about financial expenses and taxes. So obviously operating profit divided by revenue gives you operating margin. So where is the operating income? 4429. So 4429 divided by, it's about 14% for Starbucks. So before they have to worry about financial costs and taxes, they get to keep about 14 cents of every dollar of sales they make. Then we're gonna look at if they do interest income, interest expense. So net they have interest expense, which is a lot of money, about $400 million. And then you get pre-tax income. If you divide pre-tax income by revenue, it's basically your pre-tax margin. Then tax provision. That doesn't necessarily mean that Starbucks actually paid that much tax. If they pay less than that, that's going to create a deferred tax asset. So according to this, the tax rate is 9484231. 22%. which happens to be the federal corporate income tax rate. But that doesn't necessarily mean that they pay that much. I mean, we know Amazon, for example, didn't pay any federal taxes, even though when you look at their financial statements, there's a tax provision. And how that happens is the subject of PhD level accounting. I have former classmates who got a PhD from economics from Princeton. He's now a managing partner in Deloitte and Touche, and the only thing he does is what they euphemistically call transfer pricing, which means use different tax jurisdictions to optimize tax liabilities. That's all he does. And probably these days you can do it with AI. Maybe I should tell my son to do something like that. My older son is going to double major in data science and artificial intelligence. That thing is future. I mean, over the next 20 years, we may have a sentient AI. Which is scary. I mean, if you think about Skynet, that is not completely outside the realm of possibilities. Because somehow, if the AI is able to rewrite its own base code, you're in trouble. Because you don't know what sort of ethical limitations AI is bringing. You can write in the base code that you will not harm human beings. Who's a human being? Unless you can define it in a way that makes sense to AI, you're in trouble. Then, net financial expense. That gives you pre-tax income. And finally, that gives you net income. As you can see, at each layer, we tell final and final stories. Are we good in selling stuff relative to what it costs to produce? That's the gross margin. What's the overhead look like? That's going to give me the operating margin. How much money am I spending to finance my assets? That's the net financial expense stuff. And how am I doing with respect to taxes? Finally, it gives me net income. A few identities, earnings before taxes. It's more like definitions, actually. It's net income plus taxes, or net income is earnings before taxes minus taxes. We will also think about earnings before taxes and interest, which is roughly operating margin, operating income, not earnings, earnings. And we're going to call this EBIT. And we're going to call earnings before taxes EBT. Again, you don't have to, just make things easier. EBIT is basically EBT plus interest expense. That's there is another term we're going to use quite a bit. It's called EBITDA, earnings before interest, taxes, depreciation, and amortization. amortization is kind of a depreciation. Sometimes you take certain assets and you amortize them according to schedule. You can do it based on useful life. So if you have a truck and you think useful life is 100,000 miles, instead of following the standard depreciation, you can amortize it. If you drove it for 10,000 miles, you amortize 1/10 of the value. If you drove it for 5,000 miles, only 5%. But in nature, it's similar to depreciation. And EBITDA, obviously, is then to the EBIT add depreciation and amortization. One thing about depreciation is it is not a cash expense. Okay? Neither depreciation nor amortizations. But in an economic sense, at least accountants view it as an expense. Why? Because you have a machinery, over time it loses its value, and if you had to replace it, it would have cost more money. So in that sense, you don't write an expense when you buy a machinery. You bought a computer for $600. That's not written as an expense like here. That's written as a capital investment. But with computers, the depreciation schedule is 3 years anyway, and that is determined by IRS. Every year, roughly, you're going to write off $200. Which means 3 years from now, if I wanted to sell that thing, I probably could get $50 in scratch. So in that sense, you incur expenses. The way we do depreciation and amortization is an approximation to those expenses. Doesn't mean that's necessarily accurate, but it is better than not writing an expense. Or it is better than writing the entire cost as an expense. Because of matching principle, you also want to match revenues and expenses to the period of accounting statements.